Mihir Vora is with us for now, Chief Investment Officer, Trust Mutual Fund. Mihir, good to have you with us here. Thanks for joining us. This rupee dynamic, right? I mean, at the margin does influence equity direction as well. What is your sense? I mean, one way to look at it is if you're a foreign investor, you're buying it closer to 90 is better than buying it closer to 88. But then, I mean, there is no certainty. This is it. But that's the minority and silver lining view. How would you look at this dynamic, Mihir?
Hi, Prashant. Always a pleasure. Thanks for having me. See, I think this rupee dynamic is what exactly Lata mentioned. The RBI will control volatility, but not the level of the rupee. Second thing is we do have FII selling on a continuous basis in the equities market, so that's obviously not that great for the rupee. And third is I think it's also the back of the mind of the RBI and the government, that we are facing stiff tariffs from the US, of course. While we hope that the trade deal will happen sooner rather than later with the US, but the exporters also probably do need some support to counter some of the tariff impact. So I think all these combinations put together, global uncertainty, FII outflows, and the tariff uncertainty is probably making the RBI to kind of let the rupee go, find its natural level, so that we have some buffer in terms of the exporters. Having said that, the government is doing its bit in terms of supporting the exporters, the MSMEs, etc. So I think it's a whole package that we are trying to give so that there is no major disruption as far as the exporters are concerned.
Mihir, you had the annual trust day on Friday, and what was did this come up in any way? Was this significant? There is some talk of liquidity being a little tight at the margin, while growth momentum is there because of GST cuts, it also means revenue collection has been hampered. You look at the tax collections of the government, April to October, it is growth of 4.5% compared to some 11% which the government had budgeted. So it's kind of both ways, right? And of course, there is a lot of supply because of welfare spending, etc. So just your thoughts. And I guess banks and financials, NBFCs will be the most impacted if liquidity remains tight. Go on.
Absolutely. So I think liquidity will not be an issue. The RBI has been doing, ad hoc or even unannounced almost OMO kind of operations in the market. So there is no way that liquidity will be allowed to remain tighter than required because we are still in the growth mindset. Let's face it, the situation or the mindset since April, May this year, or even from January, the budget where they cut tax rates for the first time for the middle class. The mindset is that we will do whatever is required to make sure growth doesn't falter. Because this currency, etc., is something that's a competitive devaluation, I would say, happening all over the world. So you have a situation where the mindset is that of money printing, and that's the reason why you see precious metals, etc., rally so hard in the last few months, because there is a money printing mindset. So I don't think beyond a point we need to worry too much about the currency. And that's the reason why, in spite of a good GDP growth print that we just saw on Friday, the consensus still seems to be on the side of 50-50, I would say, on the side of a rate cut. Normally, if you have 8% GDP growth, there's no need to cut rates. But I think people do understand that there is a deflator impact. GDP growth is not a given. There is still handholding required for business. So liquidity will continue to be provided as and when required. So I don't think we need to worry about that because globally also central banks and governments are on the fiscal, I would say, profligacy part. We are not profligate. We are just supporting to the extent required, but globally they are still on a fiscal and monetary profligacy part. So I think we should be fine as far as the currency as well as liquidity support the markets are concerned. I think the big debate is whether, because of a lack of interest in FIIs, both on equities and fixed income side, those expected benefits of inclusion in the bond index probably got pushed, by a few months. But that's fine, I think. We do have a healthy bond market in India. We do have the growth triggers required. So I think the consensus was in general, towards the side of growth rather than too much worrying about currency and inflation.
Mihir, hi. Afternoon. Exactly a year back, you all had launched the Trust Mutual Fund Small Cap when there was a lot of caution and skepticism surrounding small caps. In the index, your fund has done very well. The AUM has ballooned to more than 1,000 crore and it's delivered a return of 9-10%, outperforming the benchmark, which has been pretty much flat or maybe slightly lower. So tell us now, going ahead, about 1-2 stocks in the small cap universe that you like and why, with the appropriate disclosure.
Absolutely. So I'm sorry, I won't be able to comment on specific stocks, but the whole rationale of launching the small cap fund, even before we launched, say, a mid cap fund, the first was, of course, Flexi, and then the second fund we launched 1 year ago was the small cap fund. The whole rationale was that the canvas of the small cap universe, is very large. You have the top 100 stocks which are large cap. You have the next 150 stocks which are mid cap. So the universe of large and mid is pretty much restricted to 250 stocks. But then beyond that, there is almost another 800 to 900 stocks with a market cap of more than 2,000 crores. And that's where, in our view, a lot of the emerging segments, business models, the challengers or the untapped market potential companies come into the picture. And we found that when we are digging into the higher growth segments and sub-segments, for example, auto OEM is a normal growth segment, but auto ancillaries are a higher growth segment. Specialty chemicals, for example, is a higher growth segment. The cap goods part, where a lot of industrial capacity on the mid and large and the MSME side is happening. Machinery manufacturers, the electronic players, etc. Those are all in the small cap segment. Some of the new age companies also are starting as small or mid caps and then going into small caps. So we believe that to find growth at reasonable valuations is much easier. And of course, you need to have a bandwidth of analysts, etc., which we do have. But once you put that bandwidth, once you kick the tires and meet companies, then there is enough number of choices out there, even in volatile markets, to make a portfolio of 50, 60 stocks, which is what we have done. So, we've really been focused on growth because our whole philosophy is growth at reasonable valuations. And the skepticism was that, growth is overpriced. But we always believe that out of 800-900 stocks, to build a portfolio should not be that difficult if we really get down to it. And that's what we've delivered. So even in volatile times when the benchmark was down for the last 12 months, as you mentioned, our fund has delivered good positive performance. And I can talk about some of the niche themes that we've held in the portfolio if you want.
Can you tell us about some of the niche themes that you continue to bet on?
Certainly. So our biggest, overweight typically tends to be in the physical investment space. So industrials is one big overweight that we hold in most of our portfolios, including the small cap fund. And there we have plays in electronic manufacturing, in capital goods, in machinery manufacturing. So, for example, we have companies which supply to the Apple, manufacturing ecospace in India. Then we have companies which are very fine precision machining in plastics, etc., which supply not only to local but global pharmaceutical companies, etc. So the point is that the good part about small caps is that they really don't need to depend on the GDP growth of India in the next 1 or 2 quarters. These companies have business models which are in segments which really are organically growing so fast, emerging so fast, that it doesn't matter whether Indian GDP next quarter is going to be 6% or 8%. These companies are kind of insulated from that, both even if they are exporters or if they are catering to the domestic market. For example, if you talk about auto ancillaries, so you might see auto OEM, whether it's 2-wheelers or 4-wheelers, growing at mediocre rates in some quarters. But the point is that within a vehicle, there is so much additional value engineering happening. There is so many additional features, whether it's in safety features or electronic features or the ADA anti-locking braking system, etc. more use of electronics, more use of this fancy decoratives and the LED lamps, etc. all around. So the value per vehicle is dramatically increasing, and that's where some of our niche companies in the auto space, cater to. So again, as I said, it doesn't matter if the car market grows at 5%. The value addition per car is so much, and these companies are specialized so well that they can easily grow at 20-30%, even if the car market or two-wheeler market grows at a mediocre level. So this is the kind of approach that we are taking to stock picking. In renewables, we have some exposure. In CDMO, we have a significant exposure. And if you really get down to it, most of the options in these segments happen to be in the mid and small cap segment.
Okay, all right. We'll leave it there. A good conversation as always, Mihir. Thanks very much for joining us.